It's Sunday night. Futures are about to open, and one category of traders is not looking at earnings or CPI or the next big tech headline. They're looking at crude oil. Because when geopolitics hits an oil-producing country, prices can move before a single barrel changes hands. Not because the world instantly ran out of oil, but because markets price uncertainty faster than they price reality. And that brings us to the key question behind today's story. Is this the kind of event that creates a short-lived spike, or the kind of shift that rewrites supply expectations over years? Welcome to BullStreet Daily. If you're new here, this channel breaks down the biggest market-moving headlines in a way that's fast, clear, and actually useful. No fluff, no screaming, just logic, scenarios, and what to watch next. Quick disclaimer before we start. This is news analysis and education, not financial advice. Now, let's talk about Venezuela and the oil market, and more importantly, how to think about it like a professional. Here's the first mental model that separates casual commentary from real market analysis. Oil does not move on events. Oil moves on probabilities. The market is constantly trying to estimate what the next 3 months, the next year, and the next several years will look like, and geopolitical events are basically probability bombs. They don't just change one thing, they change the distribution of possible outcomes. So if you want to understand where prices could go next, don't ask only what happened, ask what path is the market now assigning higher odds to. In this video, the goal is simple. By the end, you should be able to explain in plain English why the same headline could lead to 3 different price reactions and what information would cause traders to shift from one view to another. Let's build this from the ground up. Start with the basics. Oil is globally priced, globally shipped, and globally substituted. That means a disruption risk in one region can show up as a price move worldwide, even for people who have never bought Venezuelan oil directly. But at the same time, the global oil market is huge. It takes a lot to change the balance enough to create a sustained trend. So oil often reacts in 2 layers. Layer 1 is immediate, the risk premium. This is the price the market pays for uncertainty, fear, insurance, and what if. Layer 2 is slower, physical barrels. This is actual production, exports, shipping, refinery intake, and inventory flows. The first layer can change in minutes. The second layer usually changes in months or years. That's why you can get big moves even when nothing physically changed yet, and also why those moves can fade quickly once traders realize that the near-term battle impact is limited. Now, apply that to Venezuela. Venezuela matters for oil for one reason above all: the gap between potential and reality. On paper, it's an oil heavyweight. In practice, the ability to turn resources into stable export supply depends on investment, infrastructure, talent, politics, and the rules of doing business. So when Venezuela's political situation changes, markets immediately start repricing 2 things at once. First, near-term disruption risk. Could exports be interrupted? Could logistics get messy? Could internal security risks rise? Could be security incidents, port issues, insurance issues, payment systems. Second, long-term supply potential. If the political environment becomes stable, investable, and predictable, could production rise over time? Could international companies return? Could the country rebuild output across a multi-year window? And here's where most people are trapped. They assume the answer must be one direction, either bullish for oil or bearish for oil. But in reality, it depends on the timeline you're looking at and the path politics takes. So rather than guessing, we're going to map 3 scenarios. This is the same approach used by macro desks and energy analysts, not because it predicts the future perfectly, but because it keeps your thinking structured when emotions and headlines are flying. Scenario 1, stabilization and a clearer transition. Scenario 2, fragmentation, conflict, or prolonged instability. Scenario 3, a dramatic headline but a limited net barrel impact in the near term. Let's walk through each, and then we'll finish with a simple watch list you can follow this week. Scenario 1 is the stability wins path. In this path, the political environment becomes stable enough for capital to return over time. Not overnight, not in a month, but gradually, in a way that allows the oil sector to rebuild. But notice what I just said. Expected future supply. Even in a best-case story, you don't rebuild an oil industry like it's a light switch. Oil production is not an app update. It is heavy infrastructure, complex operations, field services, maintenance, and a long list of bottlenecks that can't be solved with speeches. So in scenario 1, the short-term price action can still be volatile because uncertainty is still there at the beginning. But over time, the direction of pressure can become more bearish if the market starts pricing in meaningful supply growth years out. What would you look for if you wanted to know whether this scenario is gaining probability? You'd look for signs of governance clarity. You'd look for consistent rules around contracts. You'd look for signals that the operating environment will be stable enough for companies to deploy capital without fearing sudden reversals. You'd also look for language, not political speeches, market language, the kind of language that addresses the rules of the game, property rights, contract stability, safety, and payment systems. In scenario 1, the oil market might do something that surprises the average viewer. It might spike at first and then later become more bearish as the long-run picture improves. This is a classic market behavior. A shock raises short-term fear, but a credible path to stability can lower long-term risk and raise long-term supply expectations. Now you might ask, if scenario 1 can become bearish for crude, who benefits? It can benefit consumers. It can reduce inflation pressure through energy costs. It can support sectors that suffer when oil is high, like airlines and transport. It can support broader equity sentiment if lower energy inflation feeds into lower rate expectations. But it can also pressure parts of the energy sector if the market starts pricing lower long-run crude levels. So even in the good news path, the winners and losers vary by sector. Now, let's move to scenario 2, which is the instability wins path. In this path, instead of a clean transition and stable rules, you get contested power, fragmentation, or prolonged instability. This scenario is not about adding barrels, it's about losing confidence in reliability. In oil markets, reliability is everything. A barrel that exists underground is not a barrel the market can count on. A barrel that can't be shipped safely is not a barrel the market can count on. A barrel that faces operational disruption is not a barrel the market can count on. So scenario 2 tends to be bullish in the near term because it increases risk premium. And risk premium can move fast. Here's what that looks like in markets. Traders pay up for protection through options. Physical buyers may front-load purchases. Spreads can widen. Volatility expands. And crude can gap higher on the open because the market is trying to price a what-if chain. What if exports get disrupted? What if internal security risks rise? What if infrastructure becomes vulnerable? What if shipping insurance costs jump? What if payment channels tighten? Even if none of those things happen, the fear that they could happen is enough to move price. In scenario 2, you might also see Brent behave differently than WTI. Brent is more globally sensitive to geopolitical risk and seaborne crude dynamics. WTI is heavily tied to U.S. conditions, pipelines, and domestic supply-demand balances. So a geopolitical shock often shows up as a stronger relative reaction in Brent, but the exact shape depends on broader context. Now, what would confirm scenario 2 is getting more likely? You'd watch for conflicting claims of authority. You'd watch for security incidents near energy infrastructure. You'd watch for port disruptions, shipping delays, or insurance disruptions. You'd watch for signals that investors and service providers are staying away. You'd watch for an information environment that becomes louder, more chaotic, and less predictable. The main feature of scenario 2 is that it can create a sustained risk premium if the market loses confidence that the situation will stabilize quickly. But even scenario 2 has limits. Oil doesn't rally forever on fear alone if the rest of the market believes supply is abundant and demand is soft. Which brings us to scenario 3, the big headline but limited near-term barrels path. This is the scenario that markets often land on after the first emotional wave. In this path, the story is major, but the immediate physical impact is modest. You might still get a spike at the open because futures markets react to headlines and traders adjust positioning. But then, once the market asks how many barrels actually changed this week, the move can fade.
This scenario is especially likely when the broader oil market narrative is already leaning bearish, like when traders are focused on oversupply, weak demand, or heavy inventories. In that environment, geopolitical headlines must be very disruptive to create a sustained trend. Otherwise, the market treats the event like a volatility event, not a trend event. So scenario 3 often looks like this: an initial jump, a fast round of profit-taking, then a range as traders wait for confirmation data. And that brings us to the most useful part of this entire episode, the confirmation signals. Because in fast markets, the mistake is not reacting. The mistake is reacting to noise as if it's confirmation. So if you want to think like a pro, you need a simple decision framework. Ask 3 questions. Question 1. What changed today in the probability of disruption over the next 2 weeks? Question 2. What changed today